is going on.
That's weird. Why is that?
I don't know. Some kind of stupid agreement. Maybe it's because they make it easier for them to broadcast here in Hawaii. We're part of the region, I guess. But hey, why don't they just build that bridge over here from California so we could actually go over there and enjoy the game? But whatever, I'm cool with it. Just have to look at my app, or I could do some really geeky things like a VPN.
Hey, there you go.
But it's going on right now, so we'll see how we'll see if it's worth watching after today's meeting.
See, that's what's so great about Arizona is we have all the spring training. Like we have so much spring training here. It's nuts.
Yeah, I know, and I'm very jealous of that. And you also got the Phoenix Open golf. Hey, look, I'm going golfing this Sunday. I'm buying a whole huge pack of balls for it. So
Nice. You're bringing back home at least one.
At least one out of the 24 that I have. Yeah, so it's actually one of our more forgiving, really nice courses here. So super excited. I'm going to be bringing my buddy from my cop buddy. He's a cop, and I'm going to be bringing my buddy from St. Louis. He's visiting from St. Louis to here. So we're gonna have a great old time. Wish it was you though, Ray. Wish it was you.
Hey, I might have to before you leave.
Yes, I think that you should. And let's figure it out. Seriously, I want this to be some kind of like full on live mastermind. We could totally live stream from the beach. I got LTE, so
that sounds
make
good.
It work. But yeah, so okay, something really, really kind of blew me away today, Ray, and it's not like we didn't expect this. I think everybody's been looking at the news and watching what's going on with the economy, and with housing prices just going crazy all over the place, even though it's more about demand rather than pricing. Well, I looked at today's current rates, mortgage rates, okay?
Ooh.
And mind if we Google that right now? I'm gonna go ahead and I'm gonna share my screen and
go
just
ahead and share your screen.
Google it, and then let's do this thing live, because I'm very curious as to what I was about to talk about today. So I'm gonna go and so this is live Google right now. I'm gonna go ahead and do this today's mortgage rates, right? So you see me already showing the history of here. And I scroll down over here to Google's average rates as of April 6, 2022. And we're looking at, and keep this in mind, I'm seeing Hawaii because it's got my location logged in. It might show up in Vegas, as far as Vegas or something like that, once I get my VPN running to watch the Angels game. But let's change this. Let's go over to Arizona, since we're over there in Ray World. No, that didn't do anything, did it? Oh, and how much is the median prices over there? I'd say about maybe 400, 300. What is it like over there right now?
Well, so median in Phoenix and most of the Phoenix areas are, depending on the area, I mean, we're talking, around 400, okay. Mid 400s. The average sale price is well over 500 right now. And then so we're still in the high 300s here in Tucson for the median.
Okay, so yeah, so we're looking at so say if somebody's at $400,000, they put 20% down, they're looking at an $80,000 down payment. We're looking at around $320,000 loan, right? So let's just look at 300,000, and we're gonna put the whatever the down payment is on there, should be that. Arizona, and we're looking at these credit scores. This is supposedly this is good average or average good, whatever you want to call it. But let's go ahead and bump it up to the top. And you can see that it actually drops almost 0.5%, which is great. The higher your credit score is, the better your rates are, and so on and so forth. I guess it goes past the 720 mark, where the rates actually are hitting that 5.5 mark. But anything below 720, we're hitting that 6.5 mark. And I can't say on average what the average American's credit score is because it's very wonky right now. I'm thinking that there's going to be a lot of changes since the pandemic, and a lot of people are doing these roller coaster things, including myself. We're seeing these rates do some weird things. So I'm going to say let's just kind of throw it out there, just because let's say we're at like this 5.5 rate. Let's say we have the greatest credit scores in the world and we're using a 5.5 interest. Okay, crazy, because wasn't it like last week we were in the threes?
Yeah, I haven't seen it. I mean, this took years before.
Yeah.
And like literally a month.
It's so yes, we're in a very weird situation right now. I don't care what economists say or financial professionals say. All it really is you are now handed this. What are you going to do about it? Majority of the time, these articles that you see are always about blaming other people. Blame, blame, blame. Let's blame the president. Let's blame inflation. Let's blame the pandemic. Let's blame Russia. Let's blame everything else that's out there and not focus on the actual solutions that are right in front of us. So,
taking control into our hands?
what?
Let's do it.
So this is where me and Ray, as far as entrepreneurs go, we focus on the now or present and beyond. If we keep looking back, then we're going to be living in this victimhood. I don't want to be that person. I don't want to be the person who keeps blaming this or blaming that. You know what? I just went ahead and blamed broadcast systems for the blackout in Hawaii for stopping me from watching the Los Angeles Angels play. I'm not a big fan of them. I just love Shohei Ohtani. And, so what I blamed them, but guess what? I also talked about solutions here. Build a bridge, or I just set up a VPN and I'll be able to watch them. So those are the things that that always come into play when it comes to not just our basic lives, how figure things out. I'm looking at the solutions. I want to look at the solutions more than the problem. So let's talk about solutions here. Right now, we're looking at the housing market doing some crazy things. I'm still seeing homes being sold really quickly here, even when the mortgage rates are climbing up. And this is Hawaii now. I can't really speak on anywhere else. Maybe Ray could, tell me a little bit about Tucson and how things are going on over there in this last couple of weeks or so, because, we like to keep our ear on the rails, so to speak, and move when the train comes. But when it comes down to understanding the market and how this is going to work for your own personal home or as an investor such as us, we got to know who is selling and who is buying, and who's especially buying right now. So if I'm going to be doing a flip here very soon, I got to make sure that my marketability is still going to be there at the price that I wanted to release the property at. So that's why I research mortgage rates. That's why I'm really looking at my buyer and I'm putting myself in their shoes right now. And so, Ray, how does it look like in Tucson as far as, these last couple of weeks when it came down to rates going up, are properties still being sold really quickly?
So they are. We have a whole lot of new construction that is set to be completed in June and July. So they're building like out of control. I do believe there's been a slowdown on properties over 600,000.
Great.
Just because there's a lot of buyers that can no longer qualify for that. Simple as that. I mean, with these rates just this, not even this big of a jump. I mean, we saw that people's debt to income ratios, and if they did qualify for a 600, now they're down at like a $400,000 house. Like it is just because based off of payment,
Easy.
So that is always expected to be the first thing to go. We still have a lot of people coming in with some cash because and being able to scoop up the $300,000 houses. So we still have a lot of demand for under 400. Over 400, we're seeing a little bit longer times. We're seeing some cancellations too, because people have one reason or another, maybe they didn't lock in the rate, which if you have a good mortgage broker and lender, they would have already locked you by this point. Like you would have locked into something. I know people that are literally, I don't even know how that's even possible. I know somebody that basically had been under contract for 3 weeks already, and they still had not locked in the rate. And now they're out because they can't, it's way too high for them because it priced them out. So,
well, see, so now as sellers of real estate, as us as investors, it just makes us realize now we got to figure out our marketability. We got to look at, where's our prices going to go? And generally, when you see interest rates tick up like this, prices tend to drop or stagnate. Maybe in Hawaii, we'll see a stagnation at most because we're running out of land. We don't have much development going on. No new houses going up except for a few tiny places, which are like really up there right now. And it's really hard for us to, to get an idea of like how that's going to affect the Hawaii market. But over there on the mainland, you got a lot of space to still grow. Ray just said that they're still developing and building like crazy, and hoping that people actually had locked into those properties before the developer goes into a little hole. We've seen that happen before, where they ended up building at the wrong time. And, you can never know until it happens. So for us to see these things happening, what about the typical consumer? What about the person who wants to buy a house right now? Well, they're going to have to start playing with these rates. Maybe you're a shopper who found that $500,000 house, and since nobody's putting any bids on it because the interest rates are going up, you could actually lowball it, wink, and see what happens. Because you never know. You never know what's what's going to be out there, what's going to happen. And now that you're in that situation, now that you've locked yourself into a current rate of 5.5 because your credit score is awesome, you're putting the down payment and everything like that. I just wanted to model a few things out. Okay. So I did prepare a small presentation. And this particular presentation is something that I actually share with people, or the contents of it. I've never really shared this particular presentation with anybody, but I generally share this content with people who are looking at figuring out what velocity banking actually is. And the first thing that I tell people what velocity banking actually is, or before I get into it, is we need to understand the numbers. We need to understand the math. We need to understand the goal here. And if your goal is to pay off soon and save as much interest as possible, you are in the right place. Okay. We'll talk about wealth building later, because right now we're going to be focusing on the numbers right now. Okay, so let's pull up my presentation real quick. Give me just a second here. I could do it that way and open up my Zoom and share. There we go. So this is what we're dealing with right now. It's an interesting time. That's why I titled it "It's Interesting" or "Interesting." Is it interesting?
It is absolutely interesting.
Yeah, and again, we need to understand the numbers. What are we putting ourselves into? A lot of people buy a home, they get into into these things, and thank goodness that the truth in lending statements now, when you close on a home, when you buy it, now really dictate everything that you need to know, including the total cost of interest if you just stuck to the regular payment every single month for the next 30 years. I love that. Before, ladies and gentlemen, they didn't have that. They made it as difficult as possible. So what we want to do is I want to show you how this thing is calculated. What is interest? Well, interest is the cost of borrowing from a lender. Okay, whatever it is. There's always going to be a cost to borrow something. And in this case, we're talking about a currency, and that currency is the US dollar. It's really funny that I have to disclose that now because there's so much things that are being exchanged right now, and it's not even funny. And we also can look at interest as the profit to the lender, the person who's letting you borrow the money. They need to, or the currency, they need to get something back. Otherwise, it's free. They would create an opportunity cost if they just let it just roll to you for free. So we don't want that. If you are somebody who wants to borrow, or if you're somebody who wants to lend, really, this strategy, this credit banking, velocity banking strategy is magical when you apply that to these specific subjects in finance. I also look at it deeper than just the numbers, because what we need to understand is the interest rate that you get is a gauge of the relationship from whom you borrow from. And when I say that, when we started looking at that little gauge, or that little thing, let me just see if I could actually do this real quick. Yeah, okay. So when we're looking at this chart here, right? Is that what you're seeing, Ray? My little Google search here.
Yeah, I'm seeing the Google chart right now.
See this credit score? This credit scoring thing is a relationship gauge. If you have a good relationship, interest rates go low. If you have a bad relationship, interest rates go high, right? So, we have to understand that when it comes to this data or this information that you're putting yourself out, the information that you're putting out there for all the banks to see, like I said before, your credit score is basically a social media platform for all the banks to see how you are treating other banks. All right, that's the way I see it. Mm-hmm. It's funny that, I don't know where they're getting this data from. It must be from somewhere, because if you go to 640, it actually drops a little bit, which doesn't make any sense. That's really weird. Data not available for anybody below 600, apparently. So anyway, the better the relationship, the better the credits, or the better the relationship, the better the interest rate, right? So that's basically the what I'm trying to say here, as far as the gauge of the relationship from whom you borrow from. Okay, so the reason why I talk about this more than just the numbers is because we got to understand there's a give and take here. There's an art behind the science, and that art is that relationship that you borrow money from people or entities such as a bank or financial institution. Okay. So this right here is your standard amortization graphic. And, it's generally basically a 30-year mortgage. Let's always talk about 30-year mortgages. I never tell people to go into 20 or 15-year mortgages due to the fact that you stop yourself from having a choice of payments if you go ahead and put yourself in a 20 or 15-year mortgage. Keep it at 30. And if you have the ability to pay more and, make it a 15-year mortgage, then pay that amount of a 15-year mortgage in a 30-year mortgage. But just in case something does happen, you have that ability to keep that money in your pocket and deal with what would happen. Okay. And as you can see, I have a little thing here showing, month 1 to 240, which is the 20th year or so, and then of course the 30th year, which is the end of the mortgage. And these little colors over here generally represent interest in the red and principal in the green. Okay, so when we talk about mortgages, there is a principal and interest payment, and the way it's calculated is that you will be paying front-loaded interest and back-loaded principal. Okay. Front-loaded interest is basically a way for the bank to say, you know what, I'm getting my money back real quick. That's the cost of borrowing money from me. And, this is how we make money. Okay. Makes sense. They're letting you borrow money. They've created value for you, and now you got to create value for them. Okay. Most people look at this as a bad thing. Okay. What I'm saying is, regardless of how bad it looks, what is the solution? Okay. I think that's the theme here is never mind the blame. Let's talk about what's right in front of us and beyond. Okay. Now, does this look familiar? Does this little graph look familiar? Okay. If it doesn't look familiar, then, maybe we need to go deeper into the basics, and we'll talk about that more in these masterminds, or even what we actually teach in our classes. What about this? Does this look familiar? This very convoluted number, okay? And I went ahead and had the liberty of popping in today's rates and finding out what it would look like if somebody were to borrow $300,000 at 5.5. Okay, so we plug the numbers in, and this is what it looks like. So a loan for 300,000 at 5.5. I could break it down for you intellectuals out there if you want. It's basically 5.5 divided by 12 equals 0.00458, something. So I think it's like 33333 after that. And when you plug in these numbers, of course, it just becomes very, very confusing for most people. And that's why it doesn't look familiar unless you're really crazy about this stuff, like myself. But all in all, the payment comes out to about $1,703.37. Now, I did double check this by plugging in some numbers here. It does take into account the very high decimal count over here on this particular number. Therefore, if you just keep it at this number, it's not going to be the same, but you have to add all the other numbers behind it. I just wanted to share that with you. But I also use my 10B2 calculator to kind of get an idea of how it actually will look like. And so, yes, this is a $1,703.37 principal and interest payment. This is not your taxes and insurance. So just keep that in mind. So now that we got that taken care of, I'm going to show you this calculator. So here we are with 300,000 at 5.5. Let me zoom in here if I can. Oh, wrong one. 300,000 at 5.5 for 360 months. And we're looking at a 1,703 payment. Now, like always, when I share this calculator with people, I let them know that this payment actually rounds up to the nearest dollar. Since it was 37 cents, it rounded down. So we're at 1,703. So if we look at $300,000 over the 30 months that you would have this loan, of course, it's going to be this ungodly number of $313,212, meaning that you're going to be basically paying two houses, or one house for the price of two. Okay. You're getting one house for the price of two if you were to stick to this. If you refinance, even worse. Okay. And we've talked about that many times. If you don't know what I'm talking about, then please review the other, videos that we've done on refinancing and everything like that. I'm not saying it's a bad thing. I'm just saying you will be extending out this interest that you pay and the time. Let's say you keep this house for 5 years and then you sell it. Well, for 5 years, let's go down to the 60th month, 5th year, you're paying almost $80,000 in interest, and you only put in $22,000 of principal as you went and made this payment. And let's say the house appreciated $50,000. Did you profit? Well, if you did the math, then you realize that you're actually $30,000 in the hole, right? Just keep that in mind that, you're not profiting here. You are paying $80,000, even though your house appreciated by $50,000. You've already paid $80,000 in interest. Okay, so you're losing $30,000. You're giving it up, and the future value of money turns into this whole big other argument of, is it worth it? So, there's so many aspects of financing here, and that's why we are here. We want to actually give you guys a mitigation tool, or a risk mitigation tool, if you will, so that way you guys can make the right decisions based on numbers. So solutions. When we talk about velocity banking, it's not just as simple as, well, I'm going to go ahead and make a debt transfer and pay less. And, I'll be honest with you, I've been seeing a lot of ads out there for some of these these loans that are available for people to pay off credit cards or high interest debt. And the headline is, I paid off $15,000 or so and so, like that, like instantly. uh, read the fine print. Basically, they paid off the credit card debt, but they just basically transferred over to another debt. That's not paying off. That's just transforming the debt to something else, maybe something more manageable. It's a consolidation loan, so to speak. And a lot of people look at these consolidation loans as a solution for cash flow, for mitigating stress, and all these other crazy things that people think of. Whereas when you look at it, if you use the velocity banking mindset, your money or your debt would be actually better used in a revolving account, such as that credit card or series of credit cards, versus being in that loan. Okay. I'm not going to go over the details of that. We can later on. I am writing a script out for a new, very simple, very easy to understand presentation on how velocity banking works, so I can introduce it to more people out there. We got to stop looking at the advertisements. We got to stop looking at what these banks and these marketers and everything like that are putting out there, and really learn how to run the numbers ourselves to get the real truth. Okay. And not their truth, our truth. Their truth is always, what is that other word? False, right? So today's mortgage interest rates are going crazy. And if we're going to be putting ourselves into this specific situation of, say, again, we're going to be doing the $300,000 at, 5.5% interest. It's becoming one of those things that a lot of people are afraid of now. Okay. There's going to be a lot of people who are going through FOMO right now, right? They're the ones that are like, oh, I should have pulled the trigger last week. It's massive right now. I could definitely feel it. I could feel the energy of all these people right now saying, I wish I pulled the trigger last week, because last week we're at 3.75. Okay. So now that they tie themselves into the situation, or they got to drop the price, like Ray talked about, right? They were qualifying for 600,000. Now they can only qualify for 400,000 because the payments jumped up due to the interest rate jumps. I did lose a buyer like that not too long ago, and oh well, right? So when we look at these numbers, we got to understand that, yes, these payments, this information that you see here, these numbers in red, these are an option. Okay. Don't ever think that the payments that are handed to you, there's no other option. Okay. Now, yes, you put yourself in this loan, you put yourself in a 30-year loan. Okay. But let's look at the opposite end of this. Okay. Now, generally, when you see these like 15-year fixed, yes, the interest is a little lower. It's still pretty high. Okay. What I'd rather you do when we run numbers like this, it's generally like this. I'd rather have people go ahead and do 30-year fixed. Of course, we can never definitively say until we run the numbers, but yes, get yourself into a 30-year fixed and then double pay on it, because that's generally what a 15-year mortgage really is. It's just double paying a 30-year mortgage. What is it? 300 months? No, sorry, 180 months. So that's basically double that payment of that 30-year loan, isn't it? So you just double pay and then boom. Of course, if you have to adjust the 4.7, whatever that number was, yeah, it knocks off about $100. Big whoop-de-doo, right? The thing is, though, your payment was $1,700, and now you got to pay a whole $600 more per month. What if you needed that $600 that month? What if something happened? What if something, like the one of your tires on your very awesome Escalade? I've been looking at Escalades, by the way. Don't ask. Pops, and you got to spend $600 to fix it, whatever it is. You can't do that with a 15-year loan if you're already stuck in this, very slim, bad situation. So that's why you set yourself up to make the most minimum payments or the lower payments to increase your cash flow, but then go ahead and dump your cash flow against the debt, not just by prepaying your mortgage or overpaying your mortgage. By the way, that's not what velocity banking is either. But being able to use the tool and still have access to the money that you need just in case something were to happen. All right. So to me, I think that a lot of people have the misconception that velocity banking is prepaying your mortgage, using a credit card to pay your mortgage off, trying all these different things about debt transfers and not really paying off. That doesn't really, sound like velocity banking to me. What velocity banking to me is the tool to pay less interest, pay off debt much quicker, using 100% of your money effectively, and still have access to it just in case you need it. That to me is the essence of velocity banking. That to me is the magic of velocity banking. And if people don't understand that, well, let's run the numbers. Let's show a really quick process using this example here. Okay. So this example here is a very, I don't know actually how accurate this will be eventually. We're looking at really weird rates. I haven't done a 5.5 mortgage interest in a very long time, but I have run them. We'll see how this would look if somebody were to do a debt transfer / let's say we're going to use the chunking method of velocity banking in this particular situation. Now, I know that you guys may have heard of velocity banking before, and you're thinking about the HELOC method and flipping it all in there and having the lower payment and everything like that. But you know what? Majority of the banks out there right now are on variable rates with what the Fed is putting out there. I don't think it's a really good idea. Just throwing that out there for now. So if we're looking at the ability to take, this debt right here, and I'm going to say, we need a tool. We need some kind of tool, a revolving account that could actually deal with this. And, I'm not going to go into the details of using a savings account or a credit card or anything like that. I'm going to be talking about a personal line of credit. And, all the details of how to acquire a personal line of credit are one of those things that I do talk to a person one-on-one to coach them on how to talk to the bank to make sure that they get the right product for themselves. But let's just say that they did that. They got themselves into a really good situation, get themselves a PLOC, and let's give it an interest rate of like 15%. I'm just going to use a 15% APR interest rate on this particular, bank product. And let's look at a limit of, let's say, $20,000. So in other words, they qualified for a $300,000 5.5 loan. They make pretty decent money. Their credit score is great. Their debt to income ratio is low, even with that $1,700 payment. So they could actually get themselves a personal line of credit. Even if it's lower, that's cool. The tool is a tool. It doesn't need to be big. It doesn't need to be small. It just needs to be there. Okay. So once you have this tool, we're going to start incorporating it into this particular, situation over here. Now, the debt transfer is usually the first thing that I usually draw up for people. So we basically take, some of this debt over here. Let me see if I can actually point this the right way. Is there a way to rotate these things? Point up, point up, point up. Never mind.
Yeah, I wish there was an easier way to do it, but
here, boom. All right, so solutions. So what we're going to do is we're going to take some of the debt from this $300,000 at 5.5, and again, this is at 15%. So it's, what are you doing, Richie? So 5.5, and let's say your cash flow. When we run your numbers, we do a bill alignment, we do a cash recovery or cash flow recovery, finding out where the money is being stored and figuring out how to get it to where it means to you most, what you value the most. Okay. And once we figure that out, where the money is leaking towards, whether it be the government or other interest or, things that are just not producing for you, we find out that, let's say you have an extra $2,500 a month. Okay. Now I know that sometimes it's a little high for a lot of people, but that's what happened to me. I broke even every month. And then when I ran my numbers, I had an extra $2,500. It was crazy. So anyway, let's say, extra $2,500. Oh, 25,000, $2,500 a month of cash flow. Okay. It's leftovers after all expenses are paid. And what we're going to do is we're going to apply this cash flow, by using this method of chunking the mortgage down. If my cash flow is 2,500 a month, what I generally do is I multiply that by, 6 months. Okay. Now this is just an example. I'm not telling anybody to go out there. Sorry about the alarm. I'm not telling anybody out there to go out and do this same exact process. Everyone is different. This is just an example. Okay. I'm just throwing numbers out there, pulling it out of my awesome St. Louis Cardinals hat and, just putting it out there. Okay. So they won 9-0 today. So it was awesome. And, so what that equals out to is $15,000. Okay. Okay. So let's say my cash flow times 6 months is $15,000. Can I use $15,000 out of this $20,000 out of this line of credit to pay or prepay the principal of my mortgage? Absolutely, you can. And, I'm not going to, one of those other things I'm not going to go into detail is actually how to do this. Movement of money, alignment of bills, and everything like that is a very individualized strategy. I can't really tell somebody, everybody, I can't tell everybody. I can't blanket this strategy over everybody saying everybody should do this specific way of moving your money and everything like that. But what I am going to do is I'm going to act like this personal line of credit has a $20,000 limit, and I'm going to use 15,000 of it to prepay this loan. Okay. So if I do this one chunk, okay, of $15,000, and this is what I love about this calculator, is that, we show the chunk out of the, out of the mortgage. As you can see, the balance is now lower minus the interest and the payment that we already have, which is the 1703. So we're going to be making the 1703 payment plus the chunk on this first payment on this loan. And as you can see, the balance is down by a little over 15,000. Okay, because we did pay $328 to principal, and so therefore it's showing over here. The only thing that's not in our bank, our house bank, or in equity or in our pocket is this interest that we had to pay towards the bank. So let's just count this as the cost of doing business. And so when we hit that point of paying this one chunk and our balance is dropping down, we get to see how much interest we stopped ourselves from paying over the term of keeping this loan. Okay. Now, number one, before I go and, show you that really awesome number, I'm going to go back to this, bring this down to 0. And I want us to look at how long it would take us to pay $15,000 off the standard way. Okay. Now, yes, you have that extra $2,500 a month after we do a cash recovery. Before we did that, you were breaking even. So it's not like you're going to be applying $2,500 a month towards your loan anyway. But let's say you did do that. Okay. You had that extra $2,500 a month. And then you went ahead and said, you know what? I'm going to prepay my mortgage every month by $2,500 more than the payment that I'm putting in. What if something were to happen? Again, that's where the magic of Velocity Banking is. It's the leverage, the ability to use 100% of that cash flow, that $2,500, and applying it against the debt and saving you time and interest. Okay. If you don't do that, if you just went ahead and dumped $2,500 into the loan and you needed it, you're out of luck. Okay. Whether it be having to drop some credit card debt or borrow from somebody else to deal with that expense, that's how it is. So what most people do is, okay, then I'm going to prepay it by cutting it in half or even by a quarter, extra $500 a month. Then you're not using 100% of your cash flow to pay off the debt. And it's going to take much longer than if you were to use 100% of it. So this is where a lot of people get stuck in the whole idea of what is velocity banking? Isn't it just prepaying your mortgage? No, it's not just prepaying your mortgage. It's using that strategy and enhancing it enhancing it like crazy by giving you the ability to have that security and leverage of having access to that money just in case you needed it, even after you paid it into the mortgage. Okay. So, and that's how using that line of credit is the reason why. Okay. But looking at how long it will take to pay off $15,000 on your loan, we're looking at this column over here. It would take us, here we are. So I'm going to just round up 41 months and cost us $55,000 in interest to do so. Okay. 41 months and $55,000 to do so. In other words, let's go ahead and make that chunk, Ray, $15,000. See how much it saves us. 41 months and $55,000 in interest saved. You stop yourself from paying that amount over 41 months. Not the back end of the loan. You're going to be paying this. Remember, loans are front loaded in interest. And if you stop yourself from paying that interest up front, then you have the ability to now do some really cool things with that. Like, it's now money staying in your pocket. It's couponing your mortgage. You are giving the grocery store clerk a coupon for $55,000 and 41 months saved, basically, for that house, just by doing that one chunk. Now, of course, when we talk about, making that debt transfer, and we're making that debt transfer and seeing the interest saved in the day, or I'm sorry, the month saved. What if you just stopped right there? Aren't you in a better place than you were before? Well, no, because the debt is still the same. You still have $300,000 worth of debt. It's just now transformed. And yes, you stopped yourself from paying that, 40 something thousand dollars up front, or 55, whatever it was, 41 months worth up front over the term of 41 months. But if it's in another bank product that's charging you interest, then what's the difference? Especially being at 15%, which is very scary, right? Well, this is where we have to understand that just doing a debt transfer is not velocity banking. That is just moving money from one place to another, or moving debt from one place to another, robbing Peter to pay Paul, whatever you want to call it. Which, by the way, is not so bad if you know how to use it correctly. Just throwing that out there. That might trigger people. So what? It works for me. I'm 100% out of debt because of this. So whatever. So here we are with understanding that, yes, we now have two separate debts. We have a personal line of credit and a mortgage. They're both now charging us interest. So let's look at that. 15%, 15% interest on a $15,000. Not so bad. So let me zoom in here so that way you can see it closer. Pay no mind to a lot of this stuff that's over here. It's getting a little messy. So anyway, here, $15,000 at 15%. And let's say, the cash flow. The cash flow is $2,500 a month. Now, this is after the interest of the loan or the line of credit. Okay. And that's showing up as $191 here. So what I'm going to do is I'm going to give like an equal sign 2,500 plus the 191 that the interest would be charging. So here we are with $15,000 of this thing being paid. Now, let's say we didn't have our cash flow. We just did the regular debt transfer. Okay. How much of interest is it going to cost us? It's going to cost us $185 a month to hold the $15,000 in this personal line of credit. Just make regular payments of $185 a month. And if you just keep doing that over the term, like if you just keep, let's say the 191, let's just do it that way. So that way it's zeroed out all the time. What will happen is you end up paying $185 over a certain term. Now, if you look at the interest saved here, $55,000, I want to figure out how much is that per month. Okay. And, we're going to be doing a 12-month type of thing, or actually let's just do 41 months. We're gonna take 41 months, and we're gonna see the average of how much it cost us to, to just pay $55,000 over 41 months. Okay. So I'm going to take 55,516 and then divide that by 41 months. That's $1,354 a month in interest over 41 months. Okay. Over here in the line of credit, it's costing you $185 a month. So let me ask you this question. On $15,000 worth of principal mortgage debt, would you rather pay $1,354 a month or $185 a month? Ray?
Well, I'm going to go with the lower 150. Wait, you said 154?
185. 185.
185.
Yeah, it's $185 a month for the same.
Or the 1354.
Versus 1354.
Yeah. No, I'm going to go with the 185 versus the 1354.
There you go. So it's the same type of debt, $15,000 worth of principal mortgage debt. Now, it's sitting in the loan, or the mortgage costs more than it's sitting in the line of credit. That makes sense? If that was just the case, if you just left it like that, you're in a better place. That's fine. But again, that's not velocity banking. That's just debt transferring, which is great. Just not enough, because we want to pay this off. So what if you did use a strategy? What if you did actually use the effective interest rate strategy, being able to just pound away on this debt, taking that extra $2,500 a month every single month and putting it against this line of credit? Well, that's what we're going to do right now. We're going to take 2,500 plus the 185 or 191. Here's a 191. And here we are. Let's say we started this in, I don't even know if this date thing's going to start working, because we've been messing with this calculator so much. Yeah, it's messed up. It says September over here, but it's showing April. I'll figure that out. But anyway, we started at $15,000. We paid $185 for the first month, of course. That's what you have to do. But then when the balance dropped down, so did the interest drop. That's how simple interest works. Just like a mortgage, guys. You got to understand that simple interest is in a mortgage as well. A lot of people don't realize that. So if you have yourself $15,000 down to $12,494, then you pay less interest on that. Then your balance is down to $99.62 and you pay less interest on that, and so on and so forth. And at the end of 6 months, you paid off $15,000 worth of principal mortgage debt and a total of $649 in interest on $15,000 worth of debt. So let's ask this question. Let me just kind of blow this up just a bit. $649 is the total interest that you would pay on this loan at 15%, or this line of credit at 15%. Okay, on $15,000 worth of principal mortgage debt. Over here, it would cost you $55,516 over 41 months. So let me ask you this question. Would you rather pay 6 months worth of $15,000 worth of principal mortgage debt in 6 months for $649, or 41 months at $55,516? Ray?
And that's like, I'm just trying to even think. I mean, it's $54,900. I mean, that's so much money. And like, it's so hard to comprehend that doing something like this can create such massive savings. Massive,
especially now, because the interest rates are higher. Now, when the interest rates were lower, somebody would try and argue with me, oh yeah, velocity banking, we don't need it because interest rates are so low. Well, guess what? I still showed people how to save tens or even hundreds of thousands of dollars by using this strategy.
Absolutely. But I mean, we're literally going back to when velocity banking really took off a couple of years ago, is because it was just, you had to be crazy not to implement it.
Absolutely. Opportunity for us to share with more people right now, which is, again, solution based. Never mind what happened last week at 3.75. Let's focus on the 5.5 and let's share this with people and show them how to make this work for themselves. And so now that's $15,000 paid off in 6 months for $649 in interest versus 41 months at $55,516. Now, we figured this out. We made that debt transfer. We did some really cool things with it. I showed you how to align your bills. I showed you how to move your money correctly and making sure that everything is in place for the next step. And that next step, if you did this in 6 months, what would you want to do next? After your 6 months is, done and your line of credit is now paid off, right? This is here. It's at zero balance now after the 6 month. What do you do?
Well, at this point, we've washed, we've rinsed, and now we got to repeat.
So as you can see, we're doing some pretty cool things here. And I'm just going to go ahead and scroll down and see where this goes. We're looking at paying off in 85 months. That's 7 years and 1 month. It's costing us $61,190. I always said this, and this is something that I preach all the time, guys. And I need to look at you in the face when I say this. As long as you borrow money from the bank, you have to pay interest. But with Velocity Banking, it's up to you on how much. Got it? Good. So back to this. Here's your option. You either pay $313,000 in interest or you pay $61,000 or anything in between. It's still better than $313,000. Okay. Now, I got to be very clear on that. Sometimes, things are, things happen, whether somebody loses a job or they get hurt or they get a raise or they move on to a better business or whatever it is. Things change within this time frame of 7 years and 1 month from now till then. But regardless, you work with us, you know exactly what to do just in case something does happen. You have the roadmap, you have the backup plans, you have everything in place, making sure that you do reach as close to this goal as possible. For me, when I'm talking about I paid off my debt in 6 years, 100% of it, house debt, all my credit card debt, all my personal loans, my lines of credit, and everything. My business line, they're all wiped out right now because of this strategy. And yes, I jumped on this 6 years ago when the interest rates were about as where they're at right now. Okay. So just keep that in mind that it's still possible. In fact, the person who taught me was in a worse situation. Okay. Those interest rates were even higher. In fact, he was in a variable high rate, which is crazy. So knowing that this person who taught me this and, I brought it along and I'm learning about it and I'm doing it and I accomplished it. And now I get to watch baseball anytime I want. I do plan on flying over to Anaheim to just catch a game when Shohei's pitching, guys. It's going to happen. I just got to find a babysitter. Honestly, that's legitimately the real only reason why I'm not over there right now, because I couldn't find a babysitter. Just knowing that I'm out of debt. I could have done that. I could have flown over and, used my miles, my points and everything like that. My whole trip would have been free. The only thing I'd have to pay for is the ticket, so it's such an amazing feeling. And that's why we do this, because I want to share this feeling with you guys. I want to share this feeling with people who are willing to take the reins of their destiny and actually steer it the way they want. Otherwise, if you want to keep riding like this and enjoying the ride and, seeing what happens, good luck. But we're here. And if you're here, if you're here live, more power to you guys. I appreciate you guys being here. Thank you so much. So we got Santiago, Lorene. Hey, Lorene, how are you? She's going to be learning about this very deep, and she's going to be teaching it to other people. It's going to be awesome. Is that Jahan or Jahan? I don't know if it's pronounced a certain way. And Dedra, thank you so much for being here live. And Alspa, and I don't even know who's in YouTube world.
Max over here on YouTube, he was like, "This information is so epic." It's true.
Yes, I did it correct. Thank you, Jan. So we're here, okay? And I don't see myself going anywhere unless I do catch a game and you guys are and the meeting is in the time at the time. Maybe I'll zoom in while I'm at the stadium and try and do things on my phone. But until then, just understand that this works, and I cannot say it enough. And that's why we want to share with other people. Our value here is created by the things that we've learned. And the receipt of that value is you guys coming aboard and being a part of this with us. Join the Wise Guys and Ties team. Be a part of our real estate investing education system. That thing is just even more so, like, blows everything out of the water kind of a thing. And I thank all of that. I'm so grateful for learning velocity banking as early as I did. I'm so grateful that I've built many businesses based on velocity banking to get to where I'm at right now. I'm grateful for Ray, extending his hands out and saying, hey, here's a platform to share with more people. So let's get out there and share with more people, man. I'm so excited to see how this is going to work with with the new situations of finance going on right now. There's so much to talk about. And I'm still learning. Even though we accomplished this amazing goal, this milestone in our journey, there's still so much more to do. So I'm excited to keep going. So thank you so much, Ray. I just wanted to share that little craziness that we're going through right now, but let's show you how to make the solution instead of dwell on the past.
Awesome. Well, thank you, Rich. Because this is what I love, because everything is going to be changing and this has a ripple effect. So this is going to be affecting other things as well. And each and every week we're working on trying to, debunk what's happening and try to get in front of it as best as we can. So we're going to keep bringing it to you as we kind of are wrestling with it, as we're digesting it, and we're trying to see trends and where it's going and how's this going to play out and how's this going to affect us. Because let's be honest, we have no idea where they could take this. Mm-hmm. All I know is that one of the dudes at the Fed took things to like almost 20% one time. So that is behind some of this. So I don't know how high he wants to push it. Hopefully not much higher, but we need to make sure that we just keep implementing those strategies. And so, Richie, that's why I brought you here, because you're the best. You're the best. Thank you. I know. And I know that everybody here is extremely grateful for you continuing to share your knowledge. And I'm excited for our next discussion. That's for sure.
Oh yeah. Let's it's funny. I just saw this from Dedra. She said, this is awesome. I actually use this process to pay off a mortgage quickly. Good job. Awesome job. Yes, thank you. And I wish I would have known about this years ago, of course, like we all do. I mean, believe me, I was in the same boat as you. As soon as I saw those first numbers drawn up for me, I remember that first consultation and I saw this bright light at the end of the tunnel. And I'm like, why didn't I know this before? And yeah, looking forward to learning more. Well, you know what? This Dedra, just for you and anyone else who wants to see beyond just paying off debt, we do some amazing masterminds on how to build wealth with this strategy as well. It's mind-blowing because I'm doing it right now. Ray is doing it right now. We're about to set off into some really great adventures because of it. And I can't wait. I've taught so many people around me in my circle on how to make this work for them, and they're so grateful. I mean, one story is, and I talk about him quite a bit, so forgive me, Melvick, but your story is just so amazing. That this guy, he joined us in what we do, 3 years ago, and when we ran his numbers, when I ran his numbers, and we came up with all these really awesome solutions, he said, with this roadmap, I want to retire in 5 years. Okay. And he did it in 3. So it's not just about, me. It's not just about debt pay down. It's not just about, what Ray teaches in business credit and everything like that. There's so much more. and he was able to implement it all: the debt pay down, the wealth building strategies, the all the really cool background things. He just enhanced everything. And he's a former banker, guys. He's a former banker. And I could honestly tell you that most likely if he knew about this before, he would have done it. But he didn't know. He didn't know. So it's more than just debt pay down. And we share this as a cautionary thing, looking at today's rates. Okay. I wanted to point it out so badly. As soon as I pulled it up today, I'm like, that's what we're going to talk about today. And I guarantee you that this is not the first time we're going to be talking about it, because it's going to keep going on and on, whether it be stagnating right now or going up. The solution is velocity banking. Okay. From there, creating more cash flow. The solution is velocity banking. From there, building more wealth. The solution is velocity banking. It's going to enhance the journey. Okay. Can't really see anything more than that today.
Beautiful. I mean, you said a lot. And I'm like over here writing down stuff just because it starts to generate other ideas, other thoughts. And I've been on this journey for a long time, and I continue to like develop and keep going. So keep coming back, keep tuning in. If you're seeing us on YouTube first time, like, subscribe. Go ahead and you can join the Zoom call directly in the link in the video. Other than that, we look forward to seeing you guys next time.
Excellent.
Absolutely. We'll continue and make 2022 the best year yet. Thank you, Richie. Everybody, good night and God bless.